Killol Pandya, who's head fixed income at Peerless Mutual Fund Management, joins us on the show. Killol, the Fed minutes indicating that the market is perhaps taking it as a foregone conclusion that there would be a rate hike in December. What would that do for the rate differential trade, firstly, and what would that also mean for the bond yields in India?
As and when Fed will bring about a rate hike, as you correctly mentioned, the bets on a December hike are increasing. And irrespective of when the hike actually happens, there will be an impact on our currency as well as bond yields. As of now, estimates are putting the outflow at about $5 to $6 billion. And that will have its impact on the currency. Firstly, to analyze how the currency will react and be managed, we will definitely see an impact on the rupee as the money starts to flow out. However, RBI has enough tools to defend the currency. Our forex reserves are above the 8-month import cover. It is also helped by the fact that our import bills are quite low given the crude oil price situation. So RBI can easily bring about or deploy a war chest of $5 to $10 billion to defend our currency without any trouble at all. In addition, the relaxation which RBI has brought about in the FPI limits for participation in our GSEC space will provide some cushion incrementally, since we will have 6-monthly auctions of the limits, and we will have FPI money flowing in pulses. So we should not be too bothered or too troubled in the long term as far as the forex implication is concerned. However, in the immediate aftermath of the rate hike, there will be some implications for the currency. As far as the bond yields are concerned, we will see some impact on the bond yields too. We will see some outflows taking place as money does shift from India to abroad. However, given that most of the exposure which the FPIs are having is in the GSEC space, it will be tempered by the fact that after the initial movement outside, the interest rate differential, although contracted, will still remain quite substantial for FPIs to remain interested in the GSEC space. And one thing we must also understand is that FPIs are not a homogeneous group. FPIs belong to different countries, having different preferences. So whereas we might see one set of FPIs moving out, I am pretty confident that in the medium to long term it will be more than compensated by FPIs who are looking for an opening to get into the Indian bonds, and the government has already provided a mechanism for them to participate incrementally all the way till 2018 and beyond as well. There will be a short-term pain, to encapsulate what I am saying on the currency as well as bond fronts. There will be a short-term pain, but over the medium to long term it will even itself out, and we will emerge stronger on account of our positioning as the best performing EM, irrespective of even a small dip in our GDP growth rates.
Right, and Mr. Pandya, talking about the growth now, India growth has been, lower as well as slower than expected. What's your view on India as a whole, and how confident are you in terms of Modi government delivering on incremental reforms?
I continue to subscribe to the India story. I do continue to buy into the fact that India will remain the best performing EM for some time to come. Given that our competition, basically the BRIC, is out of the running for the next couple of years at least, India has a very good window of opportunity to capitalize on the fact that we have all the macros working for us. We continue to show strong domestic growth. Our domestic demand is actually suppressed or depressed rather, not suppressed, it's depressed, and if we are able to provide the right environment, our domestic consumption story itself ought to make us very attractive for FPIs as well as domestic investors. Yeah, you look at our macros. Our inflation numbers are coming down. Of course, right now they are moving up a little bit, but as we move along and into 2018, we shall see our inflation numbers dip down to below 5%. And if Raghuram Rajan is proved right, it will stay that way. Our growth numbers are being pegged at, as correctly mentioned, they are not as good as we expected them to be, but 7.5, 7.4, 7.3 all the way down to 7. I mean, I'll stick my neck out and say even at 7% we will easily be the best performing EM, and given the size of the opportunities which we provide, as an economy, we ought to be irresistible for FPIs. That is my take on how India is placed as far as an investment destination is concerned. As you correctly mentioned, a lot depends on the delivery which the government is able to bring about. As the viewpoint which we are having is that the government has its plans in place. The steps which they are looking to take are pretty much correct, and they will be providing boost and health to the economy domestically as well as internationally. But execution has been the bugbear of not just this government, of successive governments from decades actually, of the successive governments in India, and therein lies the devil is in the detail, and we ought to see how the execution works out. There are concerns which are relating to whether legislations do get passed at the parliament level, and even after the legislations do come across, we have the land bill, we have the GST bill, there is a food bill, so there are a lot of reforms which are as of now stuck. But even once they do come through, the delivery mechanism is very important. In the areas where the government has acted till now, there is there has been some success, so we can extrapolate and hold out hope that the government does have some innovative or out of the box plans to bring about implementation of the plans which it is thinking about. So there is hope, there is positivity, and whereas some of the hoopla and hype which was surrounding the Achhe Din, as it were, the frauds does seem to have reduced. I believe or I subscribe to the theory that more time needs to be given to this government to push across its agenda. Much of it is still stuck, and as and when that does happen, we will see the benefits come down to us. India is a very large economy, we are multi-layered, and that needs to be kept in mind when we talk about an ambient positivity or ambient prosperity trickling down to the people. It will take time. India, the terrain, the economic terrain, the socio-economic terrain of India is such. So I am subscribing to this line of thought that we need to give more time to the government, and as of now I am pretty hopeful and positive about the results which this government can deliver.
Okay, just one final word then, Killol, in terms of how you see the rate cycle from here on in response to the growth numbers that are likely, or the trend line that you foresee. What is the expectation? How do you correlate the two?
On this very forum, I have maintained earlier that we shall see one more rate cut in this fiscal year. I continue to hold on to that theory or that belief that we will see one more rate cut before this fiscal is out. The timing of it is dependent on a number of factors: food inflation, how the Fed moves, how the currency behaves, as well as the growth trajectory. Assuming that we see a December hike, then the timing would be proper in or around middle or end of February to bring about a rate cut. I am frankly not having too great a visibility beyond the fiscal. There are too many moving parts. We will need to see how the acceleration pans out. We'll need to see how the winter session pans out, and whether we are able to push through key legislations. We not only have to see how the Fed acts in terms of the rates, but how its stance or the tenor of Fed changes as data points keep emerging in US. The simple fact is that as Fed and RBI both become increasingly data dependent, so do we. And since the visibility of data is contingent on the volatility which we have been experiencing, it becomes difficult to make meaningful forecasts beyond a couple of quarters. As of now, I would like to limit the forecasting to the end of this fiscal. One more rate cut, and as and when that pans out, we shall see our 10-year trending down from the current 765-75 levels. We should see it trending down towards 755-50 level. That is my expectation.
Mr. Pandya, we let you go on that. Thanks very much for taking time out, chatting with us and sharing your perspective with us on Market Sense. Well, with that, let's slip into a short break at this point of time. But on the other side, we have a team of researchers who are going to be joining us, highlighting the stocks that you should be keeping on your radar.